Achieving FIRE begins with knowledge as its foundation. People aspiring for early retirement should place great importance on broadening their knowledge base. The first step involves prioritizing learning above all else. Identify the essential skills required and place emphasis on honing that particular skill set. To attain FIRE, financial independence, retire early, we must focus on developing 3 key skill categories. 1. Frugality. Frugality is a crucial aspect often overlooked by many people, who tend to focus solely on creating income or investing. However, to achieve early retirement, the first step must be learning how to minimize expenses. It is common for people to attribute their financial challenges to an income problem or bad luck in investments, but the lack of frugality often goes unnoticed. To accumulate the necessary funds for early retirement, mastering the art of frugality is the key. Since your first paycheck, you should spend money wisely, and if you have managed to save that expected amount of money through frugality, you have gained an incredibly early start on the path to financial independence. There are different ways to enhance frugality, such as meticulously recording, categorizing, and controlling expenses, cutting unnecessary subscriptions, proactively negotiating discounts with service providers and setting reminders for deal expiration dates, shopping for clothing at discount stores, and opting to drive an older car. It's also important to recognize that a penny saved holds greater value than a penny earned, primarily because earned income is subject to taxation, and money saved is after tax. While aiming to save 10% of your income is generally sufficient for retiring at the standard age, early retirement necessitates significantly higher savings. In short, if you can save half of your salary while living on the other half, each year worked equates to saving 1 year's worth of living expenses. 2. Creating income. The amount of income required to achieve financial freedom varies based on individual circumstances, total investment assets, and personal lifestyle choices. It primarily depends on your basic needs and living expenses. It's worth noting that reducing expenses can also decrease the need for income. To calculate the required yield of the investment asset for your financial independence, you can use the following formula. For retirees receiving fixed income such as Social Security or pension, it is advisable to subtract the amount of such income from yearly expenses. For example, let's consider a retired couple who requires a total of $80,000 annually to support their lifestyle, but they receive $32,000 in Social Security or pension income. In this case, they only need to generate $48,000 of income from their investment assets. If their investment assets or savings amount to $800,000, the yield requirement would be 6%. Before achieving financial independence, there are 2 primary routes to generate income. The more common route involves working in a traditional career and potentially supplementing it with side jobs or online businesses. The other route is to start investing as early as possible, as emphasized by Warren Buffett. By getting an early start, the power of compound interest comes into play, generating passive income over time. Each investment can be seen as a passive income source, and the goal is to acquire multiple income sources as soon as possible.
I was able to save $10,000 by the time I was 21, and that was a huge head start. Every dollar then is worth making $10 or $20 later on. And so if you are interested in financial matters, getting a stake early is very useful, and getting knowledge early is very useful.
3. Investing. When aiming for early retirement, investing intelligently becomes crucial. As Warren Buffett famously said, you don't get paid for being active, you get paid for being right.
We are not going to buy anything just to buy something. We will only buy something if we think we're getting something attractive. And incidentally, if things were 5% cheaper, or 10% cheaper, that wouldn't change anything materially. But we will not, we have no time frame. If the money piles up, the money piles up. And when we see something that makes sense, we're willing to act very fast, very big. But we're not willing to act on anything that doesn't check out in our view. You don't get paid for activity. You only get paid for being right.
While investing a smaller amount, such as $10,000 to $20,000, may not present significant challenges in terms of making the right investment decisions, putting all of your savings into a portfolio requires a different approach. Therefore, it is vital to prioritize avoiding deep drawdowns and preserving capital, especially during challenging economic periods. Preserving capital becomes increasingly important as investors grow older. Your portfolio should be designed to achieve lower volatility and smaller drawdowns than the market indexes while still generating growth during favorable market conditions. It is crucial for investors to understand the level of risk they are taking and determine whether it is reasonable. Dividend income investing offers several benefits in this regard. It allows investors to track the amount of income their portfolio generates, enabling them to measure their progress over time. Additionally, including dividend-paying stocks can help reduce portfolio volatility and provide a cushion against market downturns. By focusing on both income generation and risk mitigation, investors can strike a balance that aligns with their goals and risk tolerance.
If you look at the volatility in the market around names that don't pay dividends, they're extremely volatile because there's no cushion of yield. What's the value of a stock that never returns capital to its shareholders?
The growth of a portfolio can be divided into two distinct stages. The first stage is the accumulation phase, where the focus is on saving, accumulating capital, and fostering its growth. During this phase, it is essential to prioritize savings and aim for rapid growth. With time on your side, the goal is to allow your savings to compound at a relatively high rate. Assuming a 3% inflation rate, a long-term growth rate of 8% to 10% would be reasonable. This rate of growth would enable your capital to compound over several decades. The second stage occurs after retirement when you start relying on the income generated from your already accumulated portfolio. During this stage, the emphasis shifts more towards generating income rather than seeking aggressive growth. A lower growth rate, around 5% to 6%, can be deemed acceptable. Normally, portfolio growth can help extend the longevity of your portfolio, even when you need to withdraw some principal. Whether you adopt a passive or active investing approach, a dividend growth portfolio can serve as the foundation of your overall portfolio. The allocation to this portfolio may vary based on your individual conditions. Allocation between 20% to 50% of your investment is normally recommended. In the early stages of accumulation, you can even allocate more capital to maximize the compounding effect. Even if you are already in retirement, at least 20% of your investments should be allocated to growth, with a growth rate that exceeds the inflation rate. This ensures that your portfolio retains its purchasing power over time. It is reasonable to include multiple unrelated funds or stocks from different sectors that may move in different directions at times. Additionally, including hedging assets such as treasury bonds can help protect against downside risks, ensuring a fully diversified portfolio and minimizing volatility. You will also need a high-yield dividend portfolio to enhance the dividend yield of your portfolio. It typically consists of various investments such as business development companies, BDCs, closed-end funds, real estate investment trusts, REITs, covered call ETFs, and more. These holdings generally offer dividend yields above 7% or 8%.
And so my covenants are very simple. My trust has to pay out 5%. Every year I got to pay out 5%. So I'm always looking for a company that can help me with my problem of generating more yield.
While dividends provide a consistent income stream over time, reinvesting all of the dividends can further contribute to the growth of your portfolio. However, it's essential to keep in mind that higher dividend yields often come with increased risk. It is important not to solely pursue investments based on the highest dividend yields alone. Conduct thorough background research on each investment to ensure they have a history of consistent dividend payments. This is a common mistake made by new dividend investors who prioritize high yields without fully understanding the investment or its dividend history. If early retirement is your goal, it requires dedicated effort during the accumulation stage. You need to work hard to increase your income, reduce expenses, eliminate debt, adopt a Warren Buffett lifestyle, and save and invest at least 25% of your monthly income. The more you can save and invest, the better your chances of achieving financial independence early. Hopefully, this video has provided you with a roadmap for your journey. It's important to remember that everyone's situation is unique, and you may need to tailor your approach accordingly to pursue early retirement and financial independence.
We appreciate your watching. Please hit the like button below if this video helped you in any way, and don't forget to subscribe to the channel. Thanks again and see you next time.